so far, we've talked about valuations, both relative to the market, relative to one's own history. We've talked about valuations from an absolute standpoint, that is, how much do I get back no matter what everything else costs? And another way of looking at this is, all right, I pay for something now, but what do I care what it's worth? I care how much I can sell it for to somebody else. Maybe if I pay 100 now, and I have good reasons to believe somebody else will pay 115 pretty soon, then that's a 15% return on my investment, no matter what happens with the actual company. The problem with that approach is that how would you know what somebody else is prepared to pay now or later? So you have to have an idea, a systematic idea or a systemic idea of why somebody else would want to pay a certain amount or a valuation multiple in the future. And in the end, when it's turtles all the way down, investors all the way down, and back at the final turtle, you have the last investor, and that investor is paying an absolute multiple for the company, an absolute total value, because they expect to be holding forever, collecting the final cash flows from the company. So way back in the future, somebody has to be a rational, fundamental, value-based investor. And then finally, you can also just look at share prices. Just as you can look at patterns in earnings and patterns in valuation multiples, you can simply look at patterns in prices. I mean, prices is the ultimate cheat sheet. It's the summary of what everybody else is thinking on the market. So you have the buyers and sellers coming together. They are eager, in a way, to get rid of whatever they're holding, exchange their shares for cash to be able to buy something else, maybe consumption, maybe some other shares, maybe bonds or gold. And you are eager to put your cash into use, into some investment to finally get some returns. You meet at the market with different levels of eagerness, different ideas of how this stock is going to perform. And in a weird way, at every instance, the market price summarizes what all sellers and all buyers that happen to be active in that single stock, what they together think that it's worth to make that exchange today. And there are just as many intelligent or eager or rich sellers as there are buyers. And that's why we've got the current market price. And for you to have a completely different idea than everybody else, that's a pretty tall order. And that's why people usually are content with just buying the market, buying the average, or simply, like, if they like the stock, if they like the business idea, then just assume everybody else has made a correct valuation, and you will get a decent, risk-adjusted economic return from whatever you buy whenever you buy it. But my view, of course, is that quite often the price differs wildly from this efficient market hypothesis idea of always being a correct price. And it's pretty adamant from looking at historical share prices that share prices, they fluctuate wildly. They go up and down by 50%, whereas the sum of their future cash flows, or the sum of their future dividends, or their variability in earnings is much lower. It's on the order of maybe 10% per year from an average, whereas the stock price can move hundreds of percent up, or 50%, 75% down. Not long ago, Meta Platforms, the Facebook holding company, they went down from $400 to $100 per share. So it's down by 75%, down to just a quarter of their total value, based simply on something Mark Zuckerberg said about investing in virtual reality. And then when he changed his phrasing a little bit later on, the stock has since gone up from 100 to more than 700 in less than 2 years, or about 2 years. So suddenly Meta is worth 7 times as much as it was just about 2 years ago. The likely future for the company, for Meta, it has not changed over those years. Absolutely not. It's the perception that has changed. It's the risk aversion, the risk appetite that has changed, and simply flows. And flows is what determine share prices in the end and total market levels. So to make a quick summary of all I've said so far is that to make money in stocks, you need to buy at a level that is lower today than it will be in the future. What decides the future level is partly reality, actual earnings, but not least, it's about other investors' perception of those earnings. So that is what lies behind the valuation multiples. So you have reality and then you have perception. You can call it fundamentals and fiction, or you have reality and you have hopes for reality. And this is summarized in the fundamental accounting variables like sales, that is revenues, and earnings or assets, or number of clients, or level of invested capital or investments that the company is making. So those are the fundamentals, the real things that you can measure, the actual activity, the reality of the company. And the other factor of this equation is how many times these fundamentals is the market and other investors ready to pay now in the hope of getting at least as much back from another investor in the future or from simply holding forever. So in order to get these two factors to come together, the price being made up of fundamentals and fictions and hope about those fundamentals, I think you need to break the price down now and historically into these two factors, analyze them separately, and then combine them again for the future, and thus coming up with a reliable and robust idea of a range of likely outcomes for the price based on what investors have done before and what the company has done before. So what you really do is, if you take earnings as an example, you take all the historical earnings and you make a prediction about the likely continued trajectory for earnings that fits in with the company's history and with the history of the overall economy and the market, and with the history of other similar companies in the history. So these things together make for a pretty reliable forecast of where the company is likely going. And then you go back and look at valuation multiples, and you do the same for those. You look at the historical valuation multiples for this company, for its industrial peers, for the economy, and also for historical examples of similar companies in the past. It could be in the 30s or in the 70s or in the noughts. And from that you can construct likely future valuation trajectories. So if you have always been worth about 12 to 18 times earnings historically, it's pretty likely that the market will keep awarding you a 12 to 18 times multiple of earnings. And that means if you at least have a likely idea about future earnings, then it's just a question of taking that times 12 to 18 to come up with a range of future stock prices. And once you have those future stock prices, you can calculate what your implied annual return will be for the future until you reach a future earnings that you're pretty confident in. And if that annual return that you get, the total share price appreciation plus dividends on the way there, or possibly the build-up of assets, net assets within the company. When you sum all those up and distribute them over the coming years, then you arrive at a total annual return estimate. And if that is better than any other investment alternative, adjusted for the risk level and your uncertainty, then it's a good or a bad investment. And this is the gist of all value-based investing. You come up with an idea of how much value they are creating and how much other people are willing to pay for that value at different points in time. And then you rank all your investment alternatives and you just simply pick the ones that are the best.